Over the past year, silver rose from around $30 an ounce to over $85, a gain of roughly 185%. In just the most recent stretch, it moved another 7% in a single week, pushing to new multi-year highs. Moves like that don't come from a single event. They come from pressure that builds unnoticed and then releases. Silver repriced because years of industrial demand collided with supply that couldn't adjust fast enough. And the reason this happens is because silver has an identity problem. It's talked about like a store of value. It's used like an industrial input, and it's priced like the market can't decide which one matters more. That confusion is why silver feels boring for long stretches and explosive in short ones. Not because it's unpredictable, but because it's being understood through the wrong lens. When something plays two roles at the same time, small changes can stay invisible for years, and then all at once prices have to catch up. In this video, I'm going to show you what silver actually is in today's economy, why the way it's classified keeps distorting how it's priced, and how supply and demand interact very differently than most people assume. Then we'll break down 4 silver ETFs and what each one is really designed to do. And in the end, I'll show you a portfolio of these 4 silver ETFs and how that portfolio could turn a $10,000 investment into over a $390,000 portfolio over the long run. That story starts with how silver is usually thought about, and why that framing no longer fits. The reason silver keeps confusing investors isn't that the data is hidden, it's because silver gets put in the wrong mental bucket. Most people think of silver the same way they think of gold, a store of value, something that reacts to inflation, interest rates, or fear. And for a long time, that comparison mostly worked. Silver did have a monetary role, and investment demand mattered more than anything else. But that framework stopped fitting reality years ago. Today, silver sits in an uncomfortable middle ground. It's still treated like a precious metal, but it behaves more and more like an industrial input. Not fully one, not fully the other. And markets are bad at pricing things that don't fit clean categories. When industrial demand becomes dominant, price behavior changes. Silver no longer moves only when investors get nervous. It also moves when factories ramp up, when infrastructure spending expands, and when entire supply chains need more of the same material. That creates long stretches where silver feels unresponsive, followed by short periods where it suddenly reprices faster than people expect. This is why silver often looks disappointing right before it looks explosive. When economic growth slows or sentiment weakens, investors focus on silver's precious metal side and wonder why it isn't acting like gold. At the same time, industrial demand doesn't disappear. It just becomes invisible because it doesn't make headlines. Then conditions shift, inventories tighten, and silver snaps back into focus all at once. The market keeps oscillating between 2 incomplete stories. One treats silver as a cheaper version of gold, the other treats it like a basic commodity. Neither fully explains what's happening because silver is doing both jobs at the same time. Once you recognize that silver is a hybrid, a lot of its strange behavior starts to make sense. The boredom, the volatility, the sudden catch-up moves. They aren't anomalies. They're the result of using the wrong lens. And that brings up a deeper issue. If silver demand is increasingly driven by real-world systems that don't turn off easily, then the next question isn't about price charts. It's about whether supply can actually respond when pressure builds. Demand on its own doesn't move markets for long unless supply can answer it. And this is where silver behaves very differently from what most people assume. When prices rise, the instinctive reaction is to expect more production. Drill more, mine more, flood the market and balance things out. That logic works for some commodities. It breaks down with silver. A large share of the world's silver isn't mined because someone wants silver. It comes out of the ground as a byproduct of mining for other metals, mainly lead, zinc, copper, and gold. That means silver supply decisions are often made for reasons that have nothing to do with silver prices. If demand for those primary metals doesn't justify expansion, silver output doesn't surge, even if silver itself is in short supply. At the same time, bringing new supply online is slow. New mines take years to permit, finance, and build. Recycling helps at the margins, but it doesn't scale fast enough to absorb sudden increases in demand. So when silver consumption rises, supply tends to lag rather than adjust smoothly. This is why deficits matter. In 2024, the silver market ended the year with a deficit of roughly 150 million ounces, marking another year where demand exceeded supply. Over the past several years, those gaps have added up. Pressure hasn't been released, it's been carried forward. Solar is a good example of how this dynamic plays out. Global solar installations now measure in the hundreds of gigawatts each year. Once panels are installed, they don't get unbuilt because prices fluctuate. That demand is locked in by infrastructure decisions, not sentiment. When demand grows this way and supply responds slowly, prices don't adjust gently. They stay quiet longer than expected, then move quickly once investors tighten enough. That's why silver often feels inactive right before it doesn't. Supply doesn't rise on command. Demand keeps moving anyway, and that mismatch doesn't disappear. It has to show up somewhere. That raises a practical problem: how to get exposure to something like this and benefit from it. Owning physical silver is the most straightforward option. You buy the metal, you hold it, and its value moves with price. The problem is scale. Storage, insurance, and liquidity all become friction points. Physical silver works as an idea, but it's hard to use efficiently inside a portfolio. Futures, which are more like paper contracts, solve some of those issues, but they introduce new ones. Contracts expire, positions have to be rolled. Costs show up in ways that aren't obvious at first. Futures are designed for professionals managing short-term horizons, not for most long-term investors trying to express a structural view. That's why ETFs exist. They're not shortcuts, they're translation layers. They turn silver exposure into something that fits inside a brokerage account and behaves in more predictable ways. But this is where many people go wrong. They treat all silver ETFs as interchangeable, as if they're just different wrappers around the same thing. In reality, structure matters more than the metal itself. Some ETFs are built to track the price of silver directly. Others own businesses that produce silver, which adds operating leverage. Some focus on smaller, riskier companies where outcomes widen dramatically when sentiment shifts. And a few are designed to amplify short-term price movement through leverage, compressing gains and losses into a tighter window of time. Each of these approaches respond to the same underlying pressure in a different way. None of them is inherently right or wrong. They're tools designed for different jobs. And with that framework in place, we can now look at 4 specific ETFs, each representing a different layer of silver exposure. After breaking them down, I'll combine them into a single portfolio and show how that structure could turn a $10,000 investment into more than a $390,000 portfolio over the long run. But first, let's look at each of these 4 ETFs on its own. Let's start with the simplest layer. SIVR is pure silver exposure. It's physically backed, designed to track the price of silver itself, minus a relatively low expense ratio. There's no operating risk here, no management decisions, no leverage. If silver rises slowly over time as demand tightens and supply lags, this is what that reality looks like in a portfolio. That simplicity shows up in the numbers. Over the past year, SIVR returned about 162%, reflecting how sharply silver repriced when conditions aligned. Over the past decade, its average annual price growth has been around 18.8%, which is essentially silver doing what silver does over a full cycle. This layer matters because it sets the reference point. Everything else we'll talk about only makes sense relative to this baseline. Without it, it's easy to confuse volatility with progress. SIVR doesn't try to outperform silver, it just is silver, expressed cleanly and efficiently. The next layer adds business dynamics. SLVP owns companies that mine silver. That immediately changes the math. Miners don't just track the price of silver, they sell silver. Their revenues move with the metal, but many of their costs don't. When silver prices rise, margins can expand much faster than the metal itself. That's operating leverage. This is why mining stocks often outperform silver during strong cycles. Historically, that leverage shows up clearly. Over the past year, SLVP returned just over 200%, outpacing physical silver during a strong cycle. Over the last 10 years, its average annual growth rate has been around 21.3%, reflecting how mining profits tend to reprice more aggressively when conditions improve. It's not because they contain more silver, it's because profits reprice faster than commodities. That upside comes with trade-offs. Mining is exposed to cost overruns, political risk, and execution issues. You're no longer just exposed to silver prices, you're exposed to how well companies convert those prices into profits. SLVP sits in the middle of that balance, spreading exposure across established global miners while still capturing leverage. Then comes the layer where outcomes start to widen. SILJ focuses on junior silver miners. These are smaller companies, often earlier in their development cycle, where access to capital, timelines, and sentiment matter much more. When conditions are weak, these stocks can stagnate. When conditions shift, repricing can be dramatic. That dynamic is visible in performance. SILJ gained roughly 190% over the past year, reflecting how juniors tend to surge when silver sentiment returns. Over the past decade, its average annual growth rate has been about 20.1%, but those returns arrived unevenly, with long stagnant periods followed by sharp moves. That sensitivity cuts both ways. When silver prices stagnate, juniors can drift or suffer. But when silver moves decisively, this is where repricing accelerates. A modest change in expectations can dramatically alter how these companies are valued. That's complexity. Returns stop being linear. This layer isn't about stability, it's about optionality. It exists for the part of a portfolio meant to benefit disproportionately if silver moves from being ignored to being revalued. Used carefully, it can add meaningful upside. Used carelessly, it can dominate risk. The final layer of the portfolio changes something even more fundamental: time. AGQ is designed to deliver roughly 2 times the daily movement of silver. It does that through derivatives, not by holding physical metal. This means it behaves very differently over longer periods. Gains and losses are compressed. Volatility matters as much as direction. The path silver takes becomes just as important as where it ends up. This is where many misunderstandings happen. Leverage doesn't make silver better, it makes outcomes faster and less forgiving. In strong markets, sustained trends can amplify results. In choppy markets, it can erode value even if silver goes nowhere. That effect was obvious over the past year when AGQ returned over 400% during a strong silver move. Over longer periods, however, the picture smooths out. Over the past 10 years, its average annual growth rate has been around 21.8%, reflecting both the power and the cost of leverage over time. That's why AGQ isn't a core holding. It's a tactical tool. It belongs in a defined role with defined expectations. Seen together, these 4 ETFs aren't competing with each other. They complement each other. Each one expresses the same underlying pressure in a different way. SIVR reflects the metal itself. SLVP reflects business leverage. SILJ reflects optionality and sentiment. AGQ reflects time compression. The mistake most investors make is treating silver exposure as a single bet. The opportunity comes from recognizing that structure determines behavior. Once you assign each layer a job, outcomes no longer depend on any single scenario being perfect. And that's what allows portfolio construction to turn uncertainty into something measurable. Once the roles of each ETF are clear, portfolio construction becomes much simpler. Instead of trying to predict which layer will outperform, the goal is to give each mechanism equal room to work. In this structure, all 4 ETFs are equally weighted. No favorites, no forecasts baked in. Each one is responsible for a different expression of the same underlying silver pressure. Equal weighting prevents the portfolio from leaning too hard on any single outcome. If silver grinds higher slowly, the physical exposure does its job. If improving prices start to re-rate mining businesses, the miners will contribute. If sentiment shifts and optionality comes back into the space, juniors respond. And if silver enters a strong, sustained trend, leveraged exposure has room to matter without dominating the entire portfolio. Blended together, these 4 layers produce an average annual price growth rate of about 20.5% based on their actual performance over the past 10 years. But most of that return is concentrated in the last 2 years during a period of unusually strong repricing. Earlier in the decade, returns were far more modest, averaging closer to 8 to 10%, which better reflects how silver behaves through normal cycles. To remove recency bias, it makes sense to treat that lower range as the structural baseline. On top of that, an additional 3% annual uplift can be attributed to sustained industrial demand growth, not as a continuation of recent momentum, but as a steady incremental pressure that compounds over time. Taken together, this produces a more conservative 13% long-run assumption, one that reflects silver's historical behavior while allowing for the demand dynamics that are now structurally in place. In other words, this average already reflects how silver and silver-related assets behave across multiple regimes, not a single favorable scenario. Now, let's look at what the future projections look like for this portfolio. With a starting investment of $10,000, the portfolio is projected to be valued at around $11,300 after 1 year. Over longer periods, compounding becomes more visible. After 10 years, projections show a value of approximately $34,000. At 20 years, the projected value rises to about $115,000. And by 30 years, projections show the portfolio valued at roughly $391,000. No dividends are assumed here, no reinvestment boost. This is purely price appreciation driven by the structure doing what it's designed to do over time. Want to see how to turn a $10 daily investment into a $1.5 million portfolio that pays over $9,000 per month in dividend income? Click the video on screen to find out.